this is Henry Becker, Director of Research with Lighthouse Wealth Management, and this is our 2017 halftime update. Now, the last update we did was a few months back, just when Trump was coming in as president. And at that point, we had said we were bullish on stocks and bearish on bonds. And thus far in 2017, those calls appear to be fairly accurate. Let's take a quick look at a chart outlining what we've seen thus far in 2017.
So what we have here is a quick chart of breakdown of what we have year to date, actually, and 12 months ending 5/31/2017. So we have the S&P 500, which is up 8.4% this year. This is with dividends reinvested included. The Russell 2000 small cap index is 1.38. And as you can see, the EFI, which is the Europe, Asia, Far East index, is up 14. Aggregate bond index, again, 2.4. We call it mostly flat if you take out dividends. And then we have commodities, oil, as well as the commodity index, which are both down on the year. The Lighthouse Blended Index is something we built internally. And the reason we built this is because it's not just a plain index with a stock or bond. It's a diversified portfolio of U.S. stocks, international stocks, commodities, and bonds. And so as you can see from it is up 5.4% this year. And we like this a little bit more than comparing things to the S&P 500, which is, again, it's pure stock index. And most clients of Lighthouse Wealth Management, most of our clients are in diversified portfolios of one form or another, not just stocks directly. And then on the bottom of the chart, we have the Fed funds rate. As you can see, rates have gone up. The Fed increased rates earlier this year. We have the 10-year U.S. Treasury, which has gone up slightly, and we've also seen mortgages, conventional mortgages, going up. So this is a quick glimpse of what we've seen thus far for 2017.
So our medium to long-term outlook as bullish for stocks and bearish for bonds is still in place. Now, we would not be surprised to see a pullback in the stock market. And the reason for that, there's a few reasons for that. One, we're in the midst of a multi-year run in the stock market without seeing much of a breather. So let's just say we're overdue for a bit of a pullback. And then the other items have to do with the administration having difficulty repealing the Affordable Care Act. And the other is tax reform. Senator Paul Ryan recently came out and said that it's likely tax reform is going to take a bit longer than they expected. Now, we at Lighthouse suspect that we will see tax reform before we see any significant repeal in the Affordable Care Act. But both of those things would be bullish for the stock market. Now, the other item to consider is that the Federal Reserve is also looking at increasing rates. Now, they've done it once already this year, and we're probably looking at two more rate hikes in the course of 2017. Now, on a positive note, it's likely we're going to see, whether by executive order or not, some loosening of corporate regulation. And that, again, would be bullish for the stock market because we would see, hopefully see, money coming back from offshore. As well, we're likely to see capital expenditures happening within corporate America, which is very bullish for the medium to long term for stocks. Now, on a side note relating to rate hikes, obviously if we're seeing rate hikes, this would be a good time to look at mortgages. So this is our quick update, halftime update for 2017. If you have any questions, issues, or concerns, please feel free to reach out to us. Thanks.